What if I told you there's a secret score that insurance companies are using to judge you? A number that can dramatically increase your premiums for car, home, and even life insurance, all without you even knowing it exists. What if this score is based on your financial habits, tracked silently in the background, influencing how much you pay every single month? This isn't a conspiracy theory. It's a reality for millions of Americans, and it's called an insurance score. The question is, what does your score say about you, and how much is it secretly costing you? So, what exactly is this mysterious insurance score? Let us clear up one major misconception right away. It is not the same as your credit score. While they are related, they serve two very different purposes. Your FICO or Vantage score, credit score, is designed to predict the likelihood that you will pay back a loan. Banks use it to decide if they should lend you money and at what interest rate. An insurance score, on the other hand, is a number calculated by insurance companies to predict the likelihood that you will file a claim. Yes, you heard that right. They're using your financial data to guess how risky you are as a customer. The logic, from their perspective, is based on statistical correlation. Years of data analysis have shown insurers that people with certain financial behaviors tend to file more claims, or more expensive claims, than others. So, they created a proprietary algorithm to score every potential customer. A lower score signals higher risk, and higher risk means you pay a higher premium. A higher score suggests you're a lower risk, which can lead to better rates. The problem is, this all happens behind a curtain. You apply for a quote, they pull your data, calculate your score, and present you with a price. They rarely, if ever, mention the score itself or explain how it was determined. It's an invisible factor with a very visible impact on your wallet. Now for the part they really want you to know. What specific information are they tracking to build this profile on you? It goes deep into your financial life, often pulling directly from your credit report. First, they look at your payment history. Do you pay your bills on time? Every time. Late payments on credit cards, mortgages, or even utility bills can be a major red flag. To an insurer, a history of late payments suggests a lack of responsibility, which they correlate with a higher chance of risky behavior, like getting into a car accident. Next up is credit utilization. This is the percentage of your available credit that you're currently using. If you have a credit card with a $10,000 limit and a $5,000 balance, your utilization is 50%. Insurers prefer to see this number below 30%. High utilization can signal financial distress, and their data suggests that people under financial strain are more likely to file claims. Sometimes for small incidents they might otherwise pay for out-of-pocket. They also analyze the length of your credit history. A longer history of responsible credit management is a positive signal. It shows stability. If you're new to credit or have only had accounts open for a short time, you're more of an unknown quantity, which can negatively impact your insurance score. It's not about how old you are, but how long you've been successfully managing credit. Your overall debt level is another critical piece of the puzzle. This includes everything: mortgages, auto loans, student loans, and credit card balances. Having a lot of debt, especially high-interest credit card debt, can lower your score. Again, the insurer's algorithm sees this as a sign of financial pressure, which they link to a higher claims frequency. It's not about judging your lifestyle. It's a cold, hard statistical calculation. Finally, they track new credit inquiries. Have you been applying for a lot of new loans or credit cards recently? Every time you do, it generates a hard inquiry on your credit report. A flurry of these in a short period can make it look like you're desperate for cash. This is another behavior that their models have linked to higher risk, and consequently, it can ding your insurance score. They are building a detailed financial picture of you, all to predict your future behavior. So how much does this score actually affect your premiums? The difference can be staggering. Let's take a look at a real-world example. Imagine two drivers. Let's call them Alex and Ben. They are the same age, live in the same neighborhood, drive the exact same model of car, and have identical, spotless driving records. No accidents, no tickets. On paper, they should pay the same for car insurance, but they don't. Alex has an excellent insurance score. He pays all his bills on time, keeps his credit card balances low, and has a long, stable credit history. The insurance company's system flags him as a very low risk. His monthly premium for standard coverage comes in at $120. Now let's look at Ben. Ben has a few late payments on his record from a tough year, and his credit cards are nearly maxed out because of an unexpected expense. His driving record is perfect, but his insurance score is poor. The insurer's algorithm sees his financial stress and flags him as a higher-risk client. When he gets his quote, the premium for the exact same coverage is $240 a month. That's double what Alex pays. Over a year, Ben is paying over $1,400 more, simply because of a secret score based on his credit habits. This isn't a rare case. It's a common scenario playing out across the country every single day. At this point, you're probably wondering, is this even legal? Can they really charge you more based on your financial data, even if you're a perfect driver? The answer, in most of the United States, is yes. the use of credit-based insurance scores is legal and widely practiced. Insurers have successfully argued that these scores are a statistically valid and accurate predictor of risk, and regulators have largely allowed it. They claim it allows them to price policies more accurately, rewarding low-risk individuals with lower premiums. However, not every state agrees. A few have pushed back, recognizing the potential for this practice to be unfair. In California, Hawaii, and Massachusetts, the use of credit information to price auto and home insurance is banned or severely restricted. In these states, your premium is based more on traditional factors you'd expect, like your driving record, the car you drive, and where you live. For the rest of the country, though, your insurance score is a powerful and legal factor in what you pay. It's a battle between consumer advocacy groups who argue it penalizes people for being poor or facing temporary hardship, and the massive insurance industry that insists it's just good business. Knowing all this, it's easy to feel powerless, but you're not. You can take control of the data they are reusing against you and work to improve your insurance score. The steps are straightforward and will also help your regular credit score. First and foremost, pay every single one of your bills on time. Set up automatic payments if you have to. Payment history is the single biggest factor, so consistency is key. Second, actively work to reduce your credit card balances. Your goal should be to get your credit utilization ratio below 30%. If you can get it under 10%, that's even better. Pay down debt aggressively, starting with the highest interest cards first. Third, become your own watchdog. You are entitled to a free credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, every year. Get them and review them carefully for any errors that could be dragging down your score. Dispute any inaccuracies immediately. Finally, be strategic about new credit. Avoid applying for multiple lines of credit in a short span of time. Each application can cause a small, temporary dip in your score. Only apply for credit that you actually need. You don't have to be a passive victim of this hidden system. By understanding what they track and taking proactive steps to manage your financial health, you can directly influence your insurance score and, in turn, lower your premiums. The power is in your hands. The secrets of the insurance industry can cost you dearly if you're not paying attention. Your insurance score is one of their most powerful tools, but knowledge is your best defense. Don't let a number you've never seen dictate how much you pay. Take a close look at your credit report and start improving your financial habits today. Check your insurance score before it costs you hundreds or even thousands of dollars. Thanks for watching. If this video opened your eyes, hit that like button and subscribe for more insights the big companies don't want you to know. See you in the next one.